Okay, Carrie. Um, this is the section on cash budgets in chapter 20 that you were interested in, I think. So I'll just go over the PowerPoints quick, but then I have the other thing open and I'll show it to you. It's they're a pain in the neck, but this is a section of the book that is really going to be useful for you in the future. Alice is in the room with me, so I'm going to show you Alice. Say hi, Alice. There she is over there. She's playing Minecraft. Oop, my little camera. God, I don't know how to hold it. There it is.
What?
I'm showing her the Minecraft freak show.
Did you take anything?
So, anyway, this is my little office up here.
Did you take it, Adrian?
Now, so in preparing this cash budget,
No, I found it.
this is how it looks. The next step in preparing, which shows expected cash inflows and outflows during the budget period.
No, Adrian.
Managing cash flows is vital for success. And most companies set an amount of cash to require. This is what companies live and die on, is cash. And if you know anything about my lectures, cash is king. That's what venture capital is all about. So when preparing a cash budget, we add budgeted cash receipts from the beginning cash balance and deduct budgeted cash disbursements. I always think of it like, did I have to reach in my pocket or not? Is it cash or not? And if it's not cash, it's got to be things like depreciation have to be added back in. But we'll go over that. So you have this beginning cash balance, budgeted cash receipts minus budgeted cash payments equals the preliminary balance. And then when it's the general formula is if it's adequate, we can use the extra cash to repay loans and buy securities. If it's too low, we have to increase short-term loans to cover our cash position. And here's where that question in number 4, I think it is, or 3, whatever you said. TSCs are fictitious company. 40% of their sales are for cash. Remaining 60 are on credit. Let's prepare the receipts budget for TSC. Right? So you end up, here's their budget. And this is their sales budget. Remember, everything sort of works off of sales. So when we begin a cash receipts budget with sales revenue amounts taken from the sales budget, September sales is included because 60% of September sales will be collected in October. The accounts receivable balance at the end of each month is 60% of that month's budgeted sales. Cash sales are 40% of each month's sales, right? The AR balance at the end of each month is collected in full during the next month. Cash sales are added to the accounts receivable collections to get total cash receipts for the month, right? So we now can compute the budgeted cash receipts for customer as shown in the table on the slides. October's budgeted cash receipts of 24 grand from the sales of 60,000 times 40%. So there's all your calculations that go into that question. And then in the subsequent PowerPoints here, we have cash for materials, right? And I'll show you this. It's got a nice little explanation here. It's sort of the same idea, right? And if you can go in and pull these PowerPoints up to go over it again. You can see how materials purchases go from the month to month from the direct materials budget. Hopefully that's helping a little. So how do we prepare it? Now that we've completed these cash receipts from sales, cash payments from direct materials, direct labor, cash receipts from variable overhead, payments from all these other things, right? Then we can start preparing our budget. And it's not that complicated. Remember about income. Toronto sticks is what they're going to do. Income tax payable 20 grand from the beginning balance. 25,000 of equipment purchased. Agreement with its bank for loans at the end of each month. It pays interest. It repays loans after the its ending cash balances exceeds by 20 grand, so they start to pay stuff off. So we can look at it this way, and this is going to help you with the uh, homework problem right here, because you can see it. 20,000 budgeted cash receipts for October of 49,200, resulting in a total of 69,200 available for the month. Now we're ready to look at their disbursements. Here we go. We next subtract expected cash payments for direct material, direct labor, overhead, selling expenses, G&A, administration, general and administrative. Income tax of 20 grand were due September 30th, but not payable till October. Now there's a few other things affecting cash. Let's go over those. $10,000 loan and pays interest at the rate of 1% per month. They have a dividend payment of $3 grand that they plan to pay in November. Okay, so we got all these things have to go in, and that's where that question gets kind of complicated. They have an agreement for loans at the end of each month to provide a minimum cash balance of 20 grand. They want to have 20 grand in the bank at all times. That's their prudent reserve. So if the cash balance exceeds 20,000, as it does here, they use it to repay loans. Of course, you would always reduce your loan payments because you're paying interest. So the expected loan repayment of 5635 is deducted from the preliminary cash balance in October. So that means October's ending cash balance of 20 grand becomes beginning cash balance in November, right? So it's complex, but it's not. If you just think of it in terms of how getting your wallet out and actually paying things. Bookkeepers seem to do well with these questions. So there you go. There's that part of it. That should be helpful. Let me switch over to the questions themselves in Connect. You said, I think, question 3 and 4. Here is questions 2 and 3. There's 2. Just so you know, here's the explanation to get you through 2. Cash receipts for built tight. And then 3 is down here. It's the same. Oh, did you look at? Here's my info on here so that you can figure out your numbers. Now, here's this one is a bear, but it looks just like that PowerPoint that we looked at. So you can use that as a template, or you can use this one as a template to kind of figure out where we're going here. See, they got to repay some loans down here. And here's the computation from the question. Sales commissions, 10% of sales is $5,600. Interest on the bank loan, 4,400 times 1% is $44, right? So there's a couple little calculations you had to do from up top here. I know it's a pain. Reading the question is really, how you've been doing this long enough to understand it. They do their best to trip you up on these questions. So that should do it for that one. July, August, September, yes. And what were the references? Okay. Guess there wasn't any hints there. Now let's go on to number 4, right? Isn't that what you asked me for? 4, yes. So number 4, boom. And this is a two-parter, I think. Merline Manufacturing makes its product for $60 per unit, sells it for $136, 10% commission, right? And then you have all this information in here that you have to read very carefully. Use a separate piece of paper, or copy out that other one, that other slide. So this one is a budgeted sales, budgeted income statement for each of the months in January, February, March. That gives you expected results from implementing proposed changes. So they got this sales in units, January, February, March, and then it gets you to do some calculations on changes. Here they are. Explanation in number 1, right? Yeah. Requirement 1 gives you expenses. Sales commission is 10%. Advertising, 212 times 1.10. 10% is 233. Volume for the next 3 months increases by 10% per month. That's what they want. So guess what happens? December is 1,360,000 divided by 136 gives you 10,000 units, right? And then January 11,000, February 12,100, right? You're increasing by 10%. So 10,000 plus 10% is 11,000. 11,000 plus 10% is 12,100. Okay, and so on. So there you go. And in the second section, requirement number 2 is net income from art expected to increase with the proposed strategy changes? The answer is no. Why? No, March sales are not expected. The plan for increasing sales volume by reducing the price and increasing advertising would cause the company to generate less net income in the next 3 months and next quarter. And here's your sales and your COGS. You can get to your net income. So there's that explanation. I hope that'll cover it for you, Carrie. If you have any more trouble, reach out again. I'm going to upload this. It takes a few minutes, but it should be up in no time. Hope you're well, and it's great to hear from you. And I hope everybody else takes a look at this and they'll reach out as well. I'm going to put out some other stuff on writing your papers and things like that. So I'm just getting geared up in my little office here. So anyhow, have a good night.